Hello, everyone, and welcome to the January 2024 review of the taxable um, portfolio for John and Jane. As everyone can see, I have basically a new visual. Been working with someone to help me with, just adding things that kind of spruce the videos up. Hopefully, make them a little bit more visually appealing to watch. And so just keep your eyes out for some of the changes coming up. There is a learning curve that comes with it, and I don't necessarily have a lot of time to be able to invest towards it. But I do want to make them seem, at least a little bit more professional. But let's jump into some of the numbers. I'm not a financial advisor, and I don't claim to be one. And the video does not reflect the views or opinions of my employer. I do have a number of positions in common with John and Jane, and I have those listed on the screen. And then this is a real portfolio with actual shares being traded. It is not a practice portfolio. And part of the reason why I provide so much information, to which it can even seem overwhelming, is because I want to make sure that everyone knows that there is no chance that I would spend as much time as I do on this, trying to falsify everything that I've made. So pretty much all the numbers are there because I want to make sure that everyone knows that it's as real as it gets. With John and Jane, so been working with them for quite a few years. The big thing is that their financial advisor, in my opinion, took advantage of them, charged some fees that they weren't very upfront about when they changed from one company to another. And frankly, after working with John and Jane as long as I have, they decided along with me that in exchange for me helping them, that they'd allow me to basically create articles and videos so that we could create a timeline essentially of their portfolio, and in an effort to help other people. So that's really kind of the big piece here. Is I just want to challenge conventional thinking and get people to better understand their retirements, because I want them to be able to enjoy their retirement and also feel confident about their retirement. And this is just one way to do that. So for John and Jane, they are both retired. They do currently collect $1,700 a month from the taxable account. It originally started at $1,000 a month back in 2022. These withdrawals are all covered entirely by dividend and interest income. So that's one of the big things that you'll notice in these videos, is that we do focus on cash flow, and cash flow is king with everything that John and Jane has, because that's what allows us to create a more sustainable retirement for them. They do have some investments outside of what I help them with, but it's mostly just low risk bonds, certificates, and things of that nature. And then John and Jane also make my job incredibly easy because they do not have any debt or monthly payments other than basic recurring bills such as water and power and other types of common recurring bills like that. So for our headlines, in the taxable account, generated $1,528 in January of 2024, and that compares with $1,250 in January of 2023, so a pretty substantial increase. The taxable account had a balance of just under $540,000 as of January 31st, 2024, and that compares with $549,000 on January 31st, 2023. The account currently does have a cost basis yield of just under 5.5%. In it, one company recently increased the dividend, and then one company recently decreased their dividend slightly, and we will go over those numbers for both of those. So Realty Income, this is their normal 0.2% quarterly increase that they issue, nothing out of the normal here. They did recently close on their $9.3 billion acquisition of Spirit Realty Capital. As far as I'm concerned, though, I would want to see the share price go lower, or at least wait until we see the pro forma financials after the acquisition of Spirit Realty, and that's going to be on February 20th, so we'll be able to get a better idea of where things are going and what it looks like. So that acquisition of Spirit Realty is a large one, and so I would want to see some additional information. Now for WP Carey, this was seen as quite the shocker in the industry, especially after WP Carey, had reached almost $90 a share, or it might have even actually pushed just above $90 a share, almost probably a year ago. And they decided to basically spin off its office portfolio, and that was under the ticker symbol NLOP. And that now makes a WP Carey pretty much entirely an industrial warehouse REIT. They do have a 99.2% occupancy and a weighted average lease term of 11.7 years. And that's something that is pretty outstanding in terms of just numbers in the industry. So even though they did reduce their dividend by nearly 20%, I think that when I look at that they reduced their dividend as a way to be sustainable, and because we have a management team that is focused on the long-term success, rather than it being that they're cutting the dividend due to panic or due to poor financials or due to bad decisions by management. So I do see it as a very different situation. We have been adding to WP Carey now that it's dropped below $60 a share. So that is something that I would say is attractive moving forward, because it is, again, as far as I'm concerned, the company is better now than it was prior to the spinoff. Now for realty income, I like to show everyone how much dividend income was generated by this position over the last 4 years, and then also how much the position generates annually moving forward. So for realty income, since February of 2020, it's generated just under $2,470 of dividends. And then after the dividend increase, the current position is set to generate $692.55 of income annually. And then for WP Carey, we can see that it's been generating since April of 2020 $2,510 of dividends. Now, after the dividend cut, the current position, as it stands at the time this was written, is set to produce $653.60 of dividend income annually. Now, as you can see, compared to realty income, the gain loss is sitting at a negative here, and that's not necessarily something to be alarmed about. But it is something that as we accumulate some of the lower cost shares, we have things like $72 a share here, $65 a share here, $67 a share here. So we'll be able to potentially trim these positions or these higher cost positions back as things change. Now, we did make a number of trades in the month of January. Most of them were purchases, with the only sell going to Verizon, which happened to be a good timed trade. Not that timing is necessarily something that we focused on with that. We just decided to trim back that position based on the cost basis and the fact that we recently added more shares in the mid $30 range for Verizon. Now for APD, we did purchase some shares here. Unfortunately, that was their earnings report was kind of it was lackluster. There's some things going on that caused the outlook for the stock to drop. But we did actually continue to add more under $220 a share because APD is a solid company overall that I have good long-term prospects, or believe it has good long-term prospects. Rhythm Capital had its earnings report. Shares touched off on $10 a share, and we actually purchased more. It actually had a pretty good earnings report, even though it did not reflect well in the stock price. But that is something that we did decide to add more shares to. Hormel, we added some shares here. We would need to see that share price probably drop into the mid $20 share range before we'd really want to consider adding too much more. And then for Helmerich and Payne, this was also a well-timed one, right before their earnings report. And so, yeah, the stock price jumped up. Outlook looks good. And again, just lucky on the timing with that. We do have some higher cost positions with Helmerich and Payne, because a lot of that happened prior to 2020. And so we would look at trimming some of those back, if we can get the share price to move up a little bit more, probably closer to about the mid $40 a share range, based on the numbers that I remember. And then Eaton Vance, we do add to the tax advantaged closed-end fund here, regularly, usually in about 25 share increments. And that was another month where we decided to add. Now for Verizon, you can see here that we still did take a loss on these shares. This was, as I mentioned, a high cost position. So we sold off the highest cost shares in favor of the shares that we had recently purchased in the lower 30 or in the mid $30 share range. So in this case, just a tiny loss. Now, the thing to remember with the realized gain loss in the taxable account is that we try to do our best to make sure that both sides of the equation balance. So when it comes to the gains, we want to make sure that those are basically limited by the losses, but we also want to make sure that we don't have so many losses that we don't take advantage of selling some of the stocks that are maybe overvalued to help compensate for that. So it's not necessarily that it's bad to take a loss, it's just that it's bad to not use the opportunity to reduce exposure to maybe some positions that are, as I like to refer to them, flying high. Shouldn't surprise anyone that the year-to-date gain loss is going to look the exact same. This is updated through February 6th. And so, again, same exact thing as what you saw on the previous screen, because those are the only trades that have been made. Or Verizon is the only trade that has been made. Now for the January comparison, you can see here that the Iron Mountain position's been trimmed back to half the size. We did increase the size of Nordson. And then also on Washington Trust, this has had a pretty substantial increase with the stock price having moved lower, over the last about 9 months or so. And then I would say the biggest change or the biggest component of this is that now the portfolio is seeing a substantial amount from CD income and money market income. So that does produce a significant amount of the income moving forward in the taxable portfolio. So for our year-over-year comparison, we originally started, if everyone watched the video where I looked at the projections for 2024 in the taxable account, we started off with the assumption that there was going to be an 8% reduction in the income generated by the portfolio. The reason why we used 8% was because we said, what if there was no dividend increases, and what if no money was earned or no interest income was earned on the cash that's just kind of sitting there and holding. So basically, by starting at this point, I like to go with the worst case possible scenario. And after just 1 month with the amount of income that was collected, that number has dropped down to -7% from the -8% in terms of the dividend growth. So that is a positive, very positive move in the right direction. Now, John and Jane have continued to elect to take the $1,700 a month. I believe that the portfolio can easily support $1,800 a month, possibly even more. But it is up to John and Jane to let me know what they want, and so it's going to remain $1,700 moving forward until they say otherwise. My only rule, or the only thing I ask that they follow with, is to make sure that we aren't having to sell positions in order to generate the funds needed to sustain the withdrawals that are coming out of the taxable account. In the retirement accounts, that's going to be something that will happen at some point in the future, in particular in the traditional IRA. because you can't avoid it in those accounts. But in the taxable account, especially with John and Jane living well within their means, they've made my job really easy in the sense that they can live off the money that they've been collecting very easily. Now, for the account balances, you can see that from December to January, it decreased pretty considerably by about $15,000. Year over year, the account balances are down about $9,000. Now, if we add back in the money that was withdrawn, which was $1,700 a month over the last 12 months, that'd be $20,400 that we would add back in. That means that not only did John and Jane receive $20,400 in income, but actually their account portfolio balance, if we added that back in, would have been higher than where it was previously. So that is definitely a move in the right direction. Now, this previously known as the 6-year income comparison is the 7-year income comparison. And on it, what I did is I added in the kind of negative outlook for 2024 into the cost of average goods returned. And that's where we get this 12.4% since inception. And that is saying that even if we did end the year with negative 7% income growth, that would still represent a 12.4% annualized increase year over year since inception. And that is something that I would say I'm pretty proud of and very happy with, because I do expect that this number will improve and actually get into the positives. So I expect the cost of average goods return to really be somewhere closer to 16 to 17%. Probably, maybe 15% is a more reasonable number to think of. So now, as far as the cash balance comparison goes, the big thing is that in the taxable account, they are withdrawing the $20,400 a year. So that is a pretty big hit to the cash flows that are coming into the account, because basically most of the cash flow that's coming in is going out in the form of income for John and Jane to use while in retirement. But as you can see here, if we add back in the $25,000 that's in the Charles Schwab money market, that would push the account balance up to about $55,000, and that would mean that there is a substantial amount of cash on hand, especially when we look at the averages over the last 7 years that we have of history. Technically, I guess, of the previous 6 years that we have of history. So anyway, cash balances do not reflect any balances held in money markets or in certificates of deposit, and so that's part of the reason why we see this number looking lower than what it really is. Now, for the unrealized gain comparison, so we can see that the drop here, which is about in line, or pretty close to in line with that $15,000 drop in value in the account. So unrealized gain loss is above our highest averages, but down year over year. So yes, we only have 1 month reflecting the average here, but compared to the previous year, January of 2023 had a balance that was about $12,000 higher. Now for the withdrawals, this one's going to look pretty straightforward. No funds have been added to the taxable account in years. So the balances in the account are only impacted by the income from dividends, interest, capital gains, losses, and drawdown by withdrawals. We're going to keep it the same at $1,700 until John and Jane say otherwise. And I think it's kind of important to consider that, you know, how substantial these cash flows are, that if John and Jane, for example, took the $20,400 that they are receiving and reinvested that at a 5% yield CD, that would generate, you know, another $1,450 annually of income, which is about $120 a month. So that is something that really shows the power of these cash flows, especially as you get closer to retirement, but where someone hasn't hit retirement and isn't dependent on those yet, is that it can generate a lot of income, you know, even when it's, you know, relatively small amounts in terms of the big picture of things. So for the withdrawals comparison, what I wanted to do here was I adjusted these numbers to end up showing here's what we got in 2023. Here's what we would get in 2024 if we excluded all CD and money market income, and then also said there were no dividend increases during that time. This column here says here's what we actually received in certificate and money market income to get us to our total income here. Now, on this here, these 3%, 5%, and 7% columns are intended to serve as kind of markers so that you can see, okay, relative to this and where these are, what does the 3%, 5%, or 7% increase look like? And had it been a 7% increase, this total income here would have been the $1,338.10. But because it was the $1,528.24, that shows that it's an actual increase of 22.2% compared to 2023's income that was generated. Okay, so while this looks pretty crazy and very significant, I do expect that we're going to see some weakness in some of these other months because there's no way that this portfolio is generating 22% increases in income year over year. So I think that this table just represents, or part of the reason why I like this table is because it represents how important CD and money market income has become to the portfolio. So this is something that I used in the estimates screen, and I think it's going to be pretty helpful moving forward. Now for the current gain loss, as I've always said, it's the most important table. It shows the good and the bad. Always be aware of folks that make outlandish claims about their portfolio and how much money they earn from something, because in a sense, it's easy to make it look like your portfolio is performing really well. And the example I like to use is that on this portfolio here, when you take the previous screens that I've showed you in terms of like the realized gain loss, this is just showing what would happen if we actually sold these shares at the time that these numbers were pulled. And you can see here that there's losses and gains that go with it, but it's possible that I could have sold off a position like VFC here, hit this, and then made it look like we don't have many losses. So we could sell off all the losers and make it look like our portfolio is performing absolutely phenomenally. So that's something I just like to always make sure people are aware of when looking at other people's work, is that if things are too good to be true, it's because they're probably too good to be true. But I think the biggest thing here is that you just have to learn to accept, especially on this gain loss column, that income needs to be the primary focus, and that these gain losses are just something that's not important. It's just more of a secondary feature or a secondary aspect of the investing process. And if anything, it really should just be where you would look at these and go, okay, does a position represent too much of the account? Does it represent too much of the total income that's coming through? So really, seeing a gain loss here or a gain here specifically, might be something where you want to look at actually selling and then needing to offset it. So like previously we had sold some shares of Apple, and the reason why we did that is because we wanted to reduce our exposure to it and also take some of the gains off the table, and that was used to offset some of the losses on some shares that we had sold. So anyway, like I said, I just think that this table is really important. Please know that this is an error right here that I just noticed, but I'm not going to go back and remake this video because it takes me way too long. And so this is at 100% in terms of the account. It's just that I forgot to include one of the numbers that's on here. So now for the conclusion here, I think we're starting to see the market come to terms with the fact that a rate decrease in the near term is extremely unlikely. This is something that I have said in previous videos, that I just think that the market was being way too optimistic about exactly what was going to take place. There is some very conflicting data coming through in terms of the like the workplace and employment. I think it's kind of interesting that we just saw the numbers come out saying that we added tons of jobs, but yet at the same time, I saw this report from Resume Builder where they conducted a survey and it said 4 out of 10 companies said they're likely to have layoffs, and more than half of companies said that they expect that they'll have a hiring freeze in 2024. I will say that the company that I work for, we did have a small layoff of a few employees, and yeah, it's something that's totally realistic that I expect more places will be doing, and that's where also I saw along that Resume Builder uh, survey was that artificial intelligence is likely going to have massive implications. And the example it used is that Google is reportedly looking at laying off as many as 30,000 employees in its ad sales department. And basically, that's just their way of saying AI has actually effectively replaced people. It is actually more effective than those employees are. And what I find really fascinating about that is that those employees, probably contributed to the AI technology that replaced them. And so that's going to be a really interesting trend to see moving forward, is that you have employees that are being productive and contributing towards data and systems and things like that, and that data, those systems are basically what's being used by AI to basically make it so that that person's job is obsolete. So anyway, I just think it's a really interesting turning point that we're getting to. I think it has happened a lot faster than I ever personally would have expected, because it was even just a decade ago that people were talking about in my industry, in the finance industry, that loan officers were going to be a job that would be difficult to replace by AI, because AI didn't have the ability to look at a credit report and really analyze it and understand and take debts and do restructurings and kind of some of these more complicated things. And the truth is that now there's companies out there where they pretty much rely on AI entirely, and I would say that it does a pretty darn good job most of the time, at least, especially if it's a higher quality borrower, someone that has pretty solid credit. So anyway, I'll get off my soapbox on that one, but just really keep an eye out for some of this AI stuff and the layoffs that come with it. And I just don't believe that these jobs reports that are coming out are really indicating the strength of the economy. So anyway, thanks everyone for watching. I will be working on the other videos, and again, like, subscribe, anything you can do to help me with the YouTube algorithm is greatly appreciated. Take care, and I will continue making more videos and posting more content for those who are interested. I appreciate everyone's time, and have a great day.